Hey guys, welcome back to the course. So in this lecture, we're going to talk about loans and specifically small business loans. Now, if you remember from the previous lecture where we covered equity and debt, loans are a form of debt. For the most part, loans are going to come from a bank. There's some exceptions to that. For the most part, you're going to focus on banks and credit unions. Loans typically range really anywhere from $10,000 to I've seen them upwards of $300,000. It's specifically what you ask for. If you need more money than that, you can go through banks, but it's an entirely different category, and it's something that's kind of outside of the scope of this lecture. So how does this work? Well, it's relatively simple. Banks have money, and they gather their money by people depositing it in checking accounts and mutual funds and other financial instruments. One of the ways that they make money is they invest in small businesses. So it's really a set process. You'll go to a bank, approach them, ask for a loan, and if you meet the requirements, they'll approve or deny your loan. It's really that simple. There's not a ton of subjective judgment. They usually just have a criteria list that if you meet it, then you can get a loan. Now let's talk about the pros and cons of going this route. One of the pros is that bank loans and loaned money in form of debt is some of the cheapest money you can get. It's not uncommon to get a small business loan that's 6% APR a year, as in after a year you owe 6% in interest. That is incredibly cheap, and if you assume that your business is going to become successful, then 6% is nothing. Also keep in mind, you just paid 6% as opposed to giving away a piece of your company. So if you plan on being very successful, then loans are a decent option. They also can give you a pretty wide range of money, which is great. If you only need $10,000, you can do that. If you need close to $500,000, you can also do that. Now the cons are a little bit more prominent. The first one is that they have a higher bar to qualify than any other investment structure. Banks specifically, in order to invest in you, are going to need one of two things, and occasionally they'll waive these, but for the most part, it's one of these two. One is that you need already existing cash flow, and the other one is assets. So the first one is cash flow, and they obviously look for cash flow in your business, meaning you're already making some form of money. It doesn't necessarily have to be profit, but you are taking in money. They see that as an indication that you're more likely to be able to pay back the loan because you have money to work with, and this is not really a speculative business. You just need to get to profitability or grow. And then assets are good because they know that in the worst case scenario, they can seize those, and that's how they get their money back. So if you already noticed this, banks really only care about minimizing their risk. They don't really care about the upside and maximizing how much they make in a positive outcome or a positive scenario. Another con of working with a bank is that if you default on your loan, that can affect you personally. If you default on an angel investment, as in an angel gives you $1 million and your business fails, you just ruined a relationship. But if you do that with a bank loan, you could easily be in bankruptcy or it could potentially destroy your credit. This is at least if you're in the United States. Also, one thing to point out is that banks typically will not invest in you unless they have 2 years of records of history. That's again how they minimize risk. So if you're just starting a business and you haven't been doing this for 2 years, it's rather hard to get a loan. The only exceptions I've seen are when you already have a pre-existing relationship with a bank, and so they might drop it down to a year. My general advice with bank loans is that there's a time and place for them, and if you are there, they're a fantastic option. Otherwise, you should probably pursue other options. So some advice if you decide to go down this route. One is that bank loans typically only make sense when you need what we call expansion capital. Expansion capital, all that means is that you need money to grow your business. It's like a scenario where you have X amount of orders you have to fill, but you don't have enough money to actually fulfill the orders. You need this cash in order to grow. If you're in a situation where you're already profitable, but you have a problem where you have too much inventory and not enough cash to purchase the things you need, that's a very standard situation where a bank loan would make sense. Some other advice would be start a relationship with a bank early on. Even if you don't feel like starting a business this year, start working with a bank and establishing a history with them. If they know you and they have a history with you, they're much more likely to forego some of the criteria for investment. Another piece of advice is try small banks and credit unions. Smaller banks typically have smaller decision structures. So when they make a decision about an investment, it's more likely that they could make exceptions because really it's only 1 or 2 decision makers within a small organization versus a large bank where it has to go through multiple chains of command. The first loan I ever took out, I got purely on the exception that I had history with the bank and I knew the owner, and that's how I did it. I was a teenager. Also, one last thing to point out is if you're going the bank route, don't try to sell them on the upside. They really don't care if you're going to make 100 times as much. They just care that the risk of them losing their investment is low. That's really it. They look for low risk investments. Also, don't forget, guys, there's a lot of other options available that are kind of in this general area. There's peer-to-peer lending, if you're familiar with things like LendingTree. There's also companies out there that are a little more progressive, like Cabbage and Swift Capital. Put those in the resources, check them out. They actually make loan decisions for businesses, I think it's instantly. And they use criteria that are quite different than the usual criteria you'd have at a bank. They're less stringent, more easy to get capital from, but make sure that you're checking the terms because the terms are a little bit different. Okay guys, that's all you need to know for now about bank loans. See you in the next lecture.